Well, joining us now with his take on what the Fed's next move means for real estate overall, commercial, multifamily, all of it. Willy Walker, Chairman and CEO of Walker and Dunlop. Always good to have you here at the set, Willy. Nice to see you.
Great to see you, David.
We came into the year with, I think, an expectation that there might be more aggressive rate cuts than certainly is going to take place. What has that already done, perhaps, in terms of the world that you're a part of, whether it's multifamily or commercial or anything else that relies, obviously, on lower cost debt to potentially prosper?
So we ended 23 with a lot of people saying, hey, we've got Fed cuts coming soon. Rates are going to go down. This is going to be great. And the projection was 6 rate cuts in the year and starting in March. And as everyone knows, that's been backed up. Now it's June and it's probably only 3 rate cuts. So what you've had for the beginning of the year is a lot of people saying, okay, I'm going to wait to see rates come down. And what I think you're now seeing is people somewhat capitulating that particularly the long bond might be in this range of 4 to 4.25 for an extended period of time. And therefore, if you've got a refinancing to do or you're trying to buy an asset, this is the financing cost that you probably should underwrite to.
Right. So this is the world you got to live in.
Exactly.
Don't wait to a certain extent. Willy, we've been talking commercial real estate with you through the pandemic and since in terms of office and back to office. Where do things stand right now? We're hearing a number of people come on and some saying it's only going to get worse in office, while others, at the same time they're saying that, seem to be starting distress funds to potentially pick some assets off. So how do we make sense of that?
I guess if you look at New York, David, it's a typical pre-pandemic, 45 million square feet a year were leased in New York. That's down to 20 million square feet today. Okay, so a massive fall off. If you look at New York, there's probably a third of the office inventory that can push rents. One Vanderbilt, where we're a tenant, they'll push rents there. It's a Class A building, main and main. Then there's probably another third that stands static, if you will, and then there's a third that probably doesn't need to exist. And so the real question is what happens to that third that doesn't need to exist? What's it do to tax rolls in cities like New York? And how does the government work with owners to make it so that they can reclassify, reuse that infrastructure? But it's a real issue. And what happens, everyone's waiting for something to break. And unfortunately, there's nothing that's going to break right now. It's kind of a slow burn. There's no one event, barring a banking crisis, that will make all of this come to the market and really clear. And so it's just going to be one building after another
But you're going to have these zombie buildings.
You're going to have zombie buildings, very much so. I mean, sort of like during the Industrial Revolution and all those warehouses that basically mills that weren't used anymore, except they happen to have been in rural areas, and we're talking about, downtown Manhattan.
Although we had factories downtown and eventually became luxurious lofts in Tribeca and Chelsea. Is repurposing going to work in the New York market?
It's super hard, Carl. I mean, taking an office building and turning it into multi, particularly given the floor plans, you've got too much internal space and the costs are extremely high. So the real question is, what do you do there? I mean, do you do vertical agriculture? There's a lot of different ideas out there, but there is no quick fix.